But as we open up the topic of charitable giving, what I'd like to give you is some kind of in-depth examples of ways that you can align your charitable giving with your tax strategy and your investment strategy in a way that it benefits all areas. And we're going to start with bunching charitable contributions. Let's go back to last week's episode where we talked about how you can benefit from a tax deductible donation in the first place. In years prior to 2026, including this year, the only people who would benefit from a charitable contribution in terms of taxes are people who itemize their deductions. So you couldn't take the standard deduction. You had to total up all of the things like your property taxes and mortgage interest and all of that. And one of the things that you could total up were charitable contributions. Moving forward, 2026 and beyond, there's multiple ways, regardless of how you file, that you could potentially benefit. If you do itemize your deductions, there's a new threshold that you have to surpass in order to take the deduction. It's 0.5% of your adjusted gross income. So somebody who has $100,000 adjusted gross income in the past, if they made $1,000 contribution, they'd be able to deduct the entire $1,000. Moving forward, there's a $500 threshold they would need to surpass. So if they donated that same amount, they would only be able to deduct half of the contribution. Conversely, for people who file for the standard deduction, there is the new ability to deduct up to $2,000 worth of charitable contributions, even when taking the standard deduction that previously did not exist.